Good morning, everyone, and welcome to our DAT IQ weekly market update. This is our update for November 8th, 2022. It's election day here in the good old United States of America. I'm Ken Adamo, Chief of Analytics here at DAT, and I'm joined by Dean Croak, who's our Principal Industry Analyst. Good morning, Dean.
Yeah, good morning, Ken. Good to be with you, as always.
Did you have a chance to get out and vote yet this morning?
I voted last week. I'd like to get things done early. I didn't like to leave it to today because it'll be quite busy here in Boston, I'm sure.
I'm a stickler for voting on election day. I think I want all of the information at my fingertips to make the best possible voting choice. So, but yeah, I encourage everyone listening to get out there and vote. I know that the absentee and early voting has been a really good thing for truck drivers, right, who might not be home on election day.
Exactly.
Yeah, it's allowed them to make sure that their voices are heard in the ballot box, so that's a good thing. So we're here every week at 10 a.m. Eastern, for those less familiar, talking about trends in the freight markets, what we're seeing, but most importantly, answering your questions. So if you have any questions, go ahead and drop those in the chat or comment section. We will do our best to get to those at the end of the show. So with that, I'm going to go on to the key points of the week as soon as I pull them up. All right, so spot rates leveling off a bit. I think you've got a bit of a calming, if you will, in some of the fuel markets. That'll be important to discuss later, but also seasonality started to take over on the dry van and reefer side, especially dry van contract replacement rates down 12% in the second half of October versus the first half. It's bid season, we know that. So it's what we would expect to see coming in with the data. LMI dropped steeply in October to 57.5. That was 76.2 in March of this year. And then a little bit of a note here about warehousing capacity, some interesting things happening in that market. And then Class 8 truck orders are strong, up 83% year over year, and the 2023 order books are open. Most of the OEMs that we've talked to or read reports on would say that they're expecting a strong H1 of next year. But I think carrier profitability is going to be sort of a governing factor in that trend. So with that, I'm going to turn it over to Dean to walk us through the market update. Dean?
Yeah, thanks, Ken. Before we get going, big shout out to all the folks I met at Freight Fest over the weekend in Houston, a very successful conference, well over 500 people there, organised by the folks at Truck and Hustle, Ramel Watley and team. Really successful event. Appreciate you having us there. So let's get started with our market update. Let's have a look at some dry van load to truck ratios and load posts and equipment posts. Volumes are down about 18% in October. Dry van spot market volumes up slightly about last week to start November, but still, generally heading down, about 41% lower than this time last year at the start of November. A little bit higher than in 2018. The number of carriers posting their equipment in search of loads as a measure of capacity was flat last week, but still remained 10% higher than in 2019 when the market was oversupplied with trucks. Just to give you a sense of how many carriers are looking for loads on the spot market, 10% higher than 2019. Load to truck ratio last week moved up slightly to 2.71. In refrigerated, load posts were up last week, increased by about 13% week over week. Again, not surprising. Seasonal trends in reefer spot market volumes are emerging in the run up to Thanksgiving. We expect this trend to continue throughout November, reversing last month's downward slide. Capacity tightened last week again. Flatbed, load to truck ratio was about 4.95 in the refrigerated sector. Having a look at flatbed, spot market volumes continue to track very closely with 2018 volumes, while capacity measured by carriers posting their equipment in search of loads mirrors 2018 when the market was, of course, oversupplied. Also, load posts down another 4% last week, down 24% in the last month. Even though equipment posts were mostly flat throughout October, they did increase again last week and remain at their highest levels in the previous 6 years. Load to truck ratio decreased slightly to 10.79. Having a look at our market condition index this week, we had a little bit of a look at the Los Angeles, California market. Los Angeles, obviously the big market, truckload volumes on the long haul lane between LA and Chicago. It's a freight lane. Trucking companies compete heavily with intermodal, have been flat for the last month. Rates have taken a hammering though. Rates have dropped continually for the last 4 weeks. They're down from $2 a mile to $1.81 per mile last week. This time last year, you remember, volume and trends were almost the exact opposite and heading in a different direction. Import volumes and port congestion have a lot to do with truckload capacity loosening. Imports into Los Angeles and Long Beach are down 12% and 16% month over month, respectively, in September. And the number of vessels waiting at anchor numbered just 3 last night. Having a look on the East Coast, capacity tightened in Florida last week. It reversed a 5-week slide throughout October. State-level freight rates for dry van up 4 cents a mile to $1.16. Remember, folks, these are line haul spot rates excluding fuel. Most of the gains in Florida last week came from the Tallahassee market, not the biggest market in the state, but spot rates did increase by 8 cents a mile to $1.45 for outbound loads. In the larger Miami dry van market, line haul rates increased a penny per mile to to just under $1 at 89 cents per mile. Having a look in the Pacific Northwest, spot rates in Washington and Oregon have been trending up in the prior 3 months, but at $1.42 a mile last week, almost identical to 2016 levels in those 2 states. One of the long haul lanes we've been watching is related to some of the congestion they've been experiencing in Seattle around the port. The 2,000-mile haul from Chicago to Seattle, spot rates were flat last week at $1.05. That's $1 per mile lower than this time last year. And in nearby Pendleton, market capacity for dry vans tightened last week. Rates were up 18 cents a mile to $1.33. Loads east to Des Moines, Iowa, very popular last week, up 10 cents a mile last week to $1.40. Having a look at the refrigerated market, we're having a look at this week at the Salinas and Yuma markets. That's where lettuce production shifts this time of the year. Salinas is just south of San Francisco, and a lot of the lettuce producers pick up all of their production facilities and move right down to the border in Yuma, Arizona. It's been delayed a week due to colder weather. We spoke to good friends of the show, Cody Kohler and Tim Bruno from ANZ Trucking last week. They said that growers they spoke to at a recent produce show are planting fewer acres this year. And because Arizona is going to take the brunt of water restrictions, they're hearing from multiple sources that produce volumes in Yuma, Arizona will be around 70% of what they'd normally be. This is important because 90% of our leafy greens come from the winter salad bowl in Yuma, Arizona between now and April. Line haul rates in the San Francisco market, which encompasses the Salinas Valley, have been dropping consistently for the last month. However, they did level off at $1.90 per mile for outbound loads to start November, after declining about 7 cents a mile throughout October. Line haul rates in nearby Fresno, the largest produce market in California, followed a similar trend, dropping 16 cents a mile throughout October. Average outbound rate at the moment is $1.79 per mile. Remember, that's excluding fuel. These are line haul rates only. In Ontario, California, including the Yuma, Arizona market, rates have been on the same downhill trend during October. They've dropped 17 cents a mile to $2.11 last week. Line haul rates in Ontario also flattened slightly last week, though. Loads from Yuma to Chicago, another busy lane for reefer carriers out of that area, $1.62 per mile. They're up 10 cents a mile last week, still 74 cents a mile lower than this time last year. DAT's Ratecast is forecasting line haul rates on this lane to increase another 45 cents a mile to $2.07 by the time we get to Thanksgiving, and then up to around $2.41 by the time we get to the end of the year. So it's quite a big jump between now and December. Having a look at flatbed, we looked this week at some of the roll-on, roll-off port markets. A lot of flatbed freight comes from non-container freight. We call that roll-on, roll-off, or RoRo containers. 55% of RoRo imports come from just 3 ports, Savannah, Houston, and Norfolk. Import volumes in Norfolk are up 73% year over year. Loads being moved out of that market are up by about the same amount. The overall flatbed rate in Norfolk, Virginia, at $2.77 a mile has been flat throughout October, while in Richmond, flatbed capacity is very tight following last week's 73 cents per mile increase to $3.73. The largest flatbed spot market in the region is Greensboro, Virginia. Capacity was tight last week. Load posts are up significantly. Line haul rates up 14 cents a mile to $2.89. Having a look at flatbed capacity on the West Coast in Los Angeles, load posts are up for the third week in a row. Los Angeles outbound spot rates for flatbed up 19 cents a mile to $2.19. And on the high volume flatbed lanes east of Phoenix out of Los Angeles, rates are up 4 cents a mile, averaging $3.01 last week. And in one of the largest flatbed markets in the country, capacity tightened last week in Jackson, Mississippi. Rates are up 25 cents a mile to $2.81. And just north in Memphis, capacity was tight for the first time in a month, following last week's 7 cents per mile increase to an average of $2.76 for outbound loads. So wrapping up our market update this week with our year-over-year look at spot rates, dry van spot rates remained relatively flat last week. National average stayed at $1.75 per mile. That's 77 cents per mile lower than this time last year. On our top 50 lanes measured by loads moved, they averaged 205. So the top 50 lanes were about 30 cents per mile higher than the national average. Compared to non-pandemic years before 2020, going back to 2016, spot rates at the start of November averaged 11 cents per mile lower at $1.62. Having a look at the refrigerated market, according to the USDA, reefer trucks remain an adequate supply in 18 growing regions. National volumes are down 13%. While in hurricane-ravaged Florida, weekly truckload volumes were 63% lower than this time last year. A little bit of produce starting to move there now that the market's starting to recover, but clearly we're off to a much slower start to the state's produce season. The potential hurricane that's about to land on the East Coast may slow things down even further. Rates were down 14 cents a mile in October in the refrigerated category, started off November flat at 206. About 95 cents per mile lower than this time last year. And lastly, in flatbed, as demand weakens in the flatbed sector, an oversupplied market continues to suppress line haul rates. According to Fast Markets this week, lumber futures fell 4% to $433 per thousand board feet. In Chicago last week, that's down 62%. And you'll record we were seeing $1,300 per thousand board feet numbers back in March. The big deal about those numbers is it's now threatening to shut down sawmills in British Columbia, one of the continent's biggest timber producing regions. So things have changed rapidly within 6 to 7 months. After dropping 58 cents a mile since the start of June, flatbed spot rates were relatively flat last week and remained at $2.07. Compared to last year, they're about 21% lower. And so that's it for this week's market update. Don't forget, you can find out more about what's happening in freight. Just go to dat.com/market update and download our weekly report this week where we're talking turkey in the lead up to Thanksgiving. And with that, it's over to Ken for the short-term forecast.
Thanks, Dean. As a hobbyist woodworker, I can't say I'm all that upset about the lumber prices falling back down, but let's just say that those declines haven't quite translated to the rough cut hardwood market just yet. All right, so let's talk about short-term forecasts. So this is a chart that's probably familiar to most, but for those who are seeing it for the first time, let me explain really quick. The blue line is the historical rate that we've observed. This happens to be dry van, which is where we start each week. It's a weighted 7-day average, moving average, so 7-day weighted moving average excluding fuel, long haul only. So you can see, going back since June where rates have trended. Then moving forward, you have some colorful lines. You have the green line, which is our rate cast model. That's what's in all of our products. It's our flagship rate forecasting model. The red line is a short-term weighted model. It tends to weight current history, like very near-term history, a lot more heavily. And then you've got a gray and a yellow line, which are blends of those two models. Moving forward. And we've been talking about this for weeks, but we saw this disagreement between the two model ensembles several weeks ago, and we're just inching closer to it. So you're starting to see more and more and more of how much they disagree heading into Christmas time. This forecast takes us through the first week or so of December. And you can see by that point, there's opening up quite a big disagreement between the two models, almost 10 cents a mile. Ratecast is banking on seasonality prevailing, short-term forecasting model, not so optimistic. And then you sort of have the middle ground there, which is expecting a bump here shortly and then settling back down before we get into that final push before the holiday. Let's take a look at reefer. very similar story. If you take a look at reefer, all of the lines mean the exact same thing, except we're talking about reefer rates, long haul, national averages. Again, short-term models being a lot more pessimistic here. Raycast is expecting a bump heading into Thanksgiving. Again, the blended models sort of split the difference there. And then in flatbed, less of a disagreement, but still, again, the model's not quite aligning on what to expect here over the next month or so. Pretty much in concert through the next couple of weeks, and then they start to diverge, although not as dramatically as reefer and dry van. That's our forecast for the week, and with that, I'm going to turn it over to Dean to hit us up with our question of the week.
Yeah, thanks, Ken. The question of this week has got to do with diesel and inventories and prices in general. The question is, how concerned should carriers be about diesel inventories heading into winter? It's a great question. It's one that I think has been on the top of everyone's lips in particular today because it's election day. There's been a lot of misinformation out there. So I'll kick it off, Ken, with just some high-level numbers. I live here in the northeast where inventories are about 45% below the 5-year average. We've got a pretty tight diesel market here. The people, though, that provide the pipeline capacity say there's absolutely no problems, a very low chance of running out of diesel. I went back and looked at the number of days of inventory, and of course one of the big headlines was we only had 25 days worth of diesel supply, and of course that translated into we're going to run out of diesel, but of course that would mean everybody would have to stop making diesel and importing it, which of course is not going to happen. So no, we're not going to run out of diesel. I did go back and look at the days of inventory. The average for the last 31 years is 35 days. So we're down to 25.8 days this week, but the average is 35 days over 31 years. The highest was 54 days of diesel supply back on June the 5th, 2020. And it's only been below the current level of 25.8 days on 52 occasions in 31 years. All of those were prior to 2008. So there's a few things going on now that are making the overreaction a bigger deal than it is. I fueled up my truck last week. I dropped in 275 gallons, $1,500 at Pilot Flying J. I'm a card member there, and the guys said there's no problems with inventories. They're building inventories both from domestic and international suppliers, so the big truck stops don't see any problems. The same was reported from TA truck stops last week on their earnings call. So lots of things going on. Of course, the inventories do drop this time of the year, though, Ken. This is maintenance season, post-summer. But of course, the big thing, of course, this year is we've lost a lot of our imports from Russia, especially on the East Coast. So I think we're going to see some, we're the furthest away from pipelines here in New England. That's one of the pads. So we're going to see, I think, tight capacity here in the Northeast. But no, we're not going to run out of diesel. We are certainly going to see high prices. And that's why I mentioned how much it costs to fill a truck. I did look at the EIA forecast for next year. They're seeing diesel prices come down to about $4.30 next year now, but that's still a long way above where it's been historically. But no, we're not going to run out of diesel, but we are going to pay a lot more for diesel, I think. And more importantly, as we head into winter, heating oil for those dependent on heating oil and natural gas.
Yeah, I mean, I think I'm really glad we covered this because I think you got the practical supply, which means I'm going to pull into a truck stop and actually fill up. And I think you did a great job of explaining that that's not going to likely be impacted. But then you have sort of like the market impact, right. Which I think is going to be more dramatic. I mean, I think we all were hoping that this was going to be a short-term bump in the road in diesel prices and gasoline prices, and then we would sort of ramp back up domestic production, and we would be back to kind of air quotes normal by now, and that's just not been the case. Yeah. I'm looking here. One of the main things we're hearing from shippers is that they're exposed. A lot of shippers still just have a national fuel scale. They don't have a pad specific or a lane specific fuel scale. So if they don't have much California shipping, I mean, latest numbers I'm looking at this morning, California pad, they subdivide pad 5 right in the West Coast, less California and California. So California is at $6.19 a gallon, and the U.S. national average is at $5.33. So if those prices are dramatically impacting that overall weighting. So I think it's something to think about, and it's something definitely weighing on shippers' minds as they're looking for ways to ensure their budgets are matching their expectations, especially on the fuel side.
Yeah, it's diesel prices are a pretty big deal. We've seen the impact on our line haul rates over the last little while. I did some math yesterday on the operating cost of running a long haul truck. I'll just quickly pull those up. If you're running a long haul truck in DAT's typical customer profile, a single truck operator, diesel's up to about 82 cents a mile. It was 52 cents a mile this time last year. It's up to about 40% of operating costs. It's a pretty big deal. Even if diesel comes back down to $4.23 a gallon this time next year, we're only going to drop operating costs down into the mid $1.80 range. I did see some data out last week from a large organisation that said truckload carrier operating costs were about $1.67 a mile, which I've got no idea how they calculate that. Maybe they weren't paying the driver at all. But certainly operating costs for small carriers are incredibly high right now. It's causing a lot of pain for a lot of drivers. I don't know how much runway they've got after an incredibly profitable year last year. That to me is the remaining question, is how much can carriers absorb? One of the things we did here, Ken, was that carriers, because they had such a great year, were able to have a lot more flexibility this year about what loads they chose and how often they chose to run, reducing their exposure to high diesel prices. That can only last so long as rates continue to sort of flatline and possibly drop. But we'll see.
Yeah, I mean, this is where a lot of carriers, a lot of retailers make their money for the year, right? So especially if you're kind of a retail-focused area of the country and you're kind of hauling a lot of that freight, this is the time of the year when you typically make a lot of your profit. So these few weeks heading in are going to be very, very crucial, especially for that 23 outlook, as we're kind of sharpening in on what we expect in 23. I think we had one question come in, and then maybe we can get a little bit of a head start on the rest of the week here and move on to plugs.
Yeah, this is from DAT Freak. I don't know who that is. Will flatbed line haul spot rates ever go back to the 2018 rates this year? It's a really good question. I'll just quickly pull up the data. We are currently sitting about 6% below 2018 levels, so we're about 14 cents a mile lower at the moment. We have been trending very closely to 2018 levels for most of the year, as you will recall from the chart. It's just more recently they've dipped away. So where they are now is kind of where line haul rates in 2018 leveled off. So I think we will see 2018 level rates between now and the end of the year. But this flatbed market has mirrored 2018 in so many ways. I think the problem is, as we mentioned during the report, the rates look like 2018, so does the number of load posts in the spot market. But capacity, when I look at the number of trucks in the flatbed market posting their trucks looking for loads, it's the highest it's ever been for this time of the year. So we've got a very oversupplied market that's going to keep rates on the downside, I think. But I think that we will see 2018 level rates, but not until the latter part of the year, I think.
Well, I think, too, we've got to realize that 2018, we were heading into the down cycle. Right now, we're in the down cycle of the market. And, depending on sort of where you have mentally kind of lodged your calendar, we're probably a quarter or two away from starting to head back up, right? So I think that's one of the positives we can find in this market is we're not sitting at 2018 levels about to go down the roller coaster hill. We're kind of at the bottom of the roller coaster hill sitting at 2018 levels. So if this is where we bottom out, I don't know that it's necessarily an overall disastrous thing for the market.
We're still building. I had a look at the housing numbers yesterday. We're still building only about 33,000 more homes than this time in 2019. This is typically a low point for flatbed volumes anyways, Ken. But a lot of lumber does start to move and build up winter inventories before we get to spring. So, and then we pick up a lot of steel and machinery imports coming in the first quarter of next year. So I think this will be the flat point for sure. We'll end up tracking ED levels.
I mean, yes, and reading some of these analyst cables that go back and forth on folks covering the large lending institutions, some of them are seeing 80 to 90% drops in new mortgage applications, which is a very sobering statistic if that kind of becomes more pervasive nationally. I know it is a slower time for home buying, right, as we head into the fall and into the winter and into the holiday season. But as interest rates continue to climb, I think you're going to see a lot of people priced out of whatever market they're shopping in. And depending on how that corrects, right, does it correct a la 2008 where housing prices implode, or do we just sort of stay at a state of stasis for a while and let demand catch back up as rates fall back down? I think there's a lot of unknowns on that side of the economy.
Right. I got one more question here, Ken, from Bob Clake. What is going on with production? I'm not sure which sector Bob's talking about, but there is no loads. Your prediction. I was looking at some of the numbers yesterday from manufacturing. Jason Miller put out. Manufacturing accounts for about 58% of the ton miles in for-hire trucking. Manufacturing numbers are up 4.6% compared to this time last year. So manufacturing production is up, but I'm not sure which production. Produce is down. Certainly retail volume is going to be down. There's no question about that. So your thoughts?
We had 900,000 load posts on our load board yesterday, right? So that was just yesterday. So there's loads. Are they where you are? Are they kind of hauling the freight you want to haul? Or are they paying what you're willing to accept? I think those are all kind of sub-questions to think about. But they wouldn't make it to our load board if they didn't need to be hauled, right? No one's out there sort of speculating. So there's freight. The question just becomes, is it profitable for you to haul that freight? Right. Is it where you're located? And it's certainly we're kind of past the point where you're going to see what was, I don't even know where it topped out, probably north of 2 million loads a day we were seeing, if I had to guess, during the absolute height of the COVID-fueled pandemic. But as it starts to normalize back, this is what sort of ends up driving us into the next upcycle. Is this cycle has to bottom out first.
Yep, exactly. Yep.
All right, any plugs, Dean?
Oh, I got a bunch this week. We got a lot going on. I'll be on Sales Chatter tomorrow with Dan Deegan. As always, 9 a.m. Eastern. Catch them on YouTube and LinkedIn. I'll also be on Radio Nemo this week with Jimmy Mack on Sirius XM Channel 146, 8 a.m. on Thursday. Don't forget, Chief of Analytics Ken Adamo, our very own Ken Adamo, and Circle Logistics VP of Sales Andrew Smith are on a webinar tomorrow at 12 p.m. Eastern on forecasting and how that can simplify the RFP process. Don't forget also, we'll be at the Women in Trucking Conference next week in Dallas. DAT will be there with our marketing team. I'll be speaking on Wednesday doing the closing keynote. And also, DAT Freight and Analytics is incredibly thankful to those who have selflessly served in our military. We've got Veterans Day coming up this week. We recognise and appreciate the sacrifices our veterans have made for the country so that we can enjoy the freedoms we have today. Don't forget to download our weekly market update at dat.com/market update. And with that, it's back to Ken to wrap up this week's show.
Yeah, and just kind of final wrap up here. If you have any questions that you didn't get in on air here or you think of throughout the week, you can always shoot them over to askiq@dat.com. We are happy to engage through that channel. With that being said, we will be back next Tuesday at 10 a.m. Eastern, just like always. We hope you have a great week. And again, just to reiterate, hope you can find some time in your day today, if you haven't already, to get out and vote. It's probably one of the most important things we could possibly do as American citizens. So thank you all, and I hope you have a great week, and we'll see you back here next week. Bye.